Intra-week, we set a new record high for gold. We got above 5,000, got above 2,530. I forget exactly what the peak was, maybe 32-ish, around there. But gold prices keep going up. Gold stocks didn't have that big a week. Many of the big name stocks did hit new 52-week highs today, and the GDX managed to hit a 52-week high, but the GDXJ, the juniors, did not. And we're only up about 1% on the week. So not a big move up, but no move down, right? The market didn't fall. And gold basically moved last week in anticipation of this week.
Gold prices recently reached a new record high, surpassing $2,530, although the exact peak might have been slightly above that. Despite this surge, gold stocks didn't see a significant rally. While some major gold stocks hit new 52-week highs, the GDX, Gold Miners ETF, also reached a 52-week high. But the GDXJ, Junior Gold Miners ETF, only gained about 1% for the week. The market held steady without any significant decline, with last week's gold price movement seemingly in anticipation of this week's developments. Peter Schiff, a well-known American economist, financial commentator, and author, talks about the recent drop in inflation from 9% to 3% was largely due to a significant rally in the dollar, which strengthened by 24% from May 2021 to October 2022. This dollar strength lowered commodity prices, including oil, which in turn helped bring down inflation. However, the dollar index has since fallen 10% and seems poised to drop another 10%, potentially reversing those gains. A weaker dollar is expected to push the CPI back up, with inflation likely to climb from 3% back to 9% or even higher. This suggests the Fed might be pivoting at the wrong time. Schiff on his live streaming tells us the US dollar took a significant hit this week. Recent news shows that the dollar index closing at its lowest in 13 months, around 100.68. If it drops further, it could hit its lowest point in years, potentially falling below 90 by the end of the year. This would challenge the 2020 low, and a further drop could lead to a sharp decline. The dollar is particularly weak against the Swiss franc, nearing a new all-time low. Since 1971, the dollar has lost about 80% of its value against the Swiss franc, making the franc a much stronger currency over time. As you watch these clips, we encourage you to take a moment to like this video, subscribe to our channel, and hit the notification bell so you're instantly alerted whenever we post new content. We appreciate your support and hope you enjoy the video.
Look at what happened with the dollar index, because the main reason that inflation came down year over year from 9% to 3% was because we had a huge dollar rally that made that happen. The dollar index rose from May of 2021 to October of 2022. It was a 24% rise in the value of the dollar relative to all the currencies in that basket. That dollar strength is what brought down commodity prices, because they're all dollar priced. Brought down oil, brought down a lot of other prices. And that is what made possible the decline in the year over year inflation rates. We went from 9% all the way down to 3%. That happened because of the strong dollar. Now, why did the dollar rally? Well, because everybody started to anticipate all the rate hikes, and that caused the dollar to go up, which brought commodity prices down, which helped bring the CPI down. So it wasn't necessarily the rate hikes that did it. It was the impact those hikes had on the exchange rate of the dollar. Well, now the dollar index is falling. In fact, it's already down 10% from its peak, and it looks like it's about to collapse another 10% very quickly. And so we're going to eradicate all of those gains. But now the dollar weakness is going to do to the CPI the opposite of what dollar strength did. So a strong dollar brought down the CPI. A weak dollar is going to push it back up. And so now we're going to see the reversal, where now the year over year numbers are going to go from 3% back up to 9%. And in fact, they're going to go higher than 9%. So the Fed is pivoting at the wrong time. Look at the dollar. The dollar got clobbered again this week. The dollar index closed at 100 spot 68. This is the lowest it's been in 13 months. And if it falls a little bit more, it's going to be the lowest it's been in several years. But then there's no real support. I think the bottom could drop out of the US dollar. I think we have a chance before the end of this year to get the dollar index below 90, and that will challenge the low from 2020. Where the dollar looks the weakest is against the Swiss franc. The dollar is about 7.5% from hitting a new all-time record low against the Swiss franc. Take a look at this chart. In fact, the chart for the dollar index closing at the low of the day, this looks horrible. And the Swiss franc right now, you need $1.18 to buy a Swiss franc. In 1971, when we went off the gold standard, you could buy a Swiss franc for 23 cents. So the Swiss franc has gone up fivefold against the US dollar since 1971. Now, of course, the Swiss franc has also lost purchasing power over that time. There's been inflation in Switzerland. So the Swiss franc doesn't buy today what it bought in 1971, but a lot more than the dollar does, because you have an 80% decline in the value of the dollar versus the Swiss franc. So the Swiss franc has been a much better currency to have held over those decades than the dollar.
Before the July meeting, it was anticipated that the Fed might cut rates, and it seemed certain they would do so by September if they didn't act in July. Although the Fed didn't cut in July, the subsequent market decline was reversed when the Fed hinted at future cuts, and major financial players began demanding emergency rate cuts. The Bank of Japan also paused its rate hikes, further supporting this expectation. The markets began pricing in a September cut, and during his Jackson Hole speech, Fed Chair Powell laid the groundwork for this expected action. Fed Chair Jerome Powell suggested that inflation is headed back down to 2%, but there's no new data supporting this claim. Inflation has been stuck around 3% for the past year, and with Powell now indicating future rate cuts, it's unlikely that inflation will drop to 2%. Instead, it's expected to rise further. The real reason Powell is shifting focus from fighting inflation to addressing economic weakness is due to concerns about the labor market. Previously, the Fed welcomed some labor market softening to combat inflation, but recent weak labor data has caused the Fed to prioritize unemployment, which is increasing. The economy has managed a 5% Fed rate because markets expected rate cuts, keeping long-term interest rates below 4% when they should have been higher. If the bond market had anticipated no cuts, long rates would have risen, leading to a market collapse. However, with inflation likely to rise and the economy heading into a recession, the Fed will be unable to cut rates. This will cause long-term interest rates to increase, making the upcoming recession particularly harsh, as both rates and prices will rise, leaving Americans unable to refinance and reduce costs as they have in past recessions. Let's dive into interview.
I've been saying that the Fed was going to cut rates in September. In fact, before the July meeting, I said I think the Fed should probably cut in July, but if they don't, they're going to do September for sure, because I thought there would be a big market decline if they didn't cut in July. They didn't cut in July, and we got the market decline, but that decline was reversed not only by the Fed basically indicating that it was going to cut, but all of the big players in the financial markets started demanding emergency cuts. We need cuts. We need cuts. And then the Bank of Japan also cooperated by calling off its future hikes. So I knew that we were going to get a cut in September. And I also knew this because the markets were pricing it in. The markets finally expected the Fed to cut, and I knew the Fed was going to deliver on those expectations. But he had to lay the foundation for that during his Jackson Hole speech, which he did today. And during this speech, Powell said that now, finally, after all of these months, now I'm convinced that inflation is headed back down to 2%. But why? What data have we seen that has shown a significant improvement that you would think that inflation is headed back down to 2%? It's 3% right now. Now, he claimed it was 2.5 because he's using maybe some kind of PCE core. But if you look at the actual CPI, we got 2.9 was the last one. we got to 3% over a year ago. So we've been hanging out around 3% for the last year. No new data points have come out that suggests that that 3% is about to become 2%. But now that Powell has indicated that we're going to start cutting rates, there's no chance that that 3% is going to become 2%. It's going to go to 4, 5, 6. It's going to keep going up. The real reason that Jerome Powell is thrown in the towel on the inflation fight, although he wants to pretend he won the fight, right, is because of the economy. And he even mentioned that during his speech today. He said that any additional weakness in the labor market is unwelcome. See, before he was saying we wanted some weakness in the labor market because that's how we were going to bring down inflation. But now, based on all of the weak data that we got on the labor market, especially that last non-farm payroll report, he's saying no mas. We can't have any more weakness in the labor market. So the Fed has really pivoted now from fighting inflation to fighting unemployment. The only reason we've been able to handle that 5% rate is because the markets have expected rate cuts. That's why the long end of the curve, even though the Fed was up at 5%, the long end was still below 4%. It should have been 7 or 8%. The only reason it wasn't was because everybody knew the Fed was going to start cutting. But if the bond market knew that they couldn't cut, well, then long rates would have gone up and then we would have seen another collapse. But I think long rates are going to go up anyway, because what's going to happen is when inflation goes up instead of down, but the economy goes into recession, there's no way the Fed is going to fight inflation when we're in recession. The bond market's going to get killed. That's why this next recession is going to be so brutal, because it's going to be accompanied by rising prices and rising long-term interest rates. We've never had that, at least not recently, because Americans have always been able to count on lower rates. So yes, it's a recession, but I can refinance my mortgage and save some money. Well, no, that's not going to happen, because rates are going to go up during the recession, and so are consumer prices.
The interplay between rising gold prices, a weakening dollar, and the Fed's uncertain stance on rate cuts is creating a precarious economic environment. As inflationary pressures resurface and long-term interest rates climb, the potential for a severe and challenging recession loom, with limited options for financial relief. Why did gold prices reach new highs, but gold stocks and ETFs like GDXJ saw only modest gains? How has the recent decline in the US dollar affected inflation? Share your thoughts on Peter's predictions in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.